Every single dollar in your wallet was created out of thin air, not printed by the government, not backed by gold sitting in some vault, created from nothing by a process so simple yet so devastating that if most people understood it, they would demand it be stopped immediately. Right now, as you watch this video, banks are creating billions of dollars that never existed before. They're doing it with a few keystrokes on a computer. No printing press required, no government approval needed, just numbers appearing on a screen backed by nothing but a promise that someone will pay it back. This isn't some conspiracy theory. This is documented fact. The mechanics are public record. Central banks publish papers explaining exactly how it works. Economics textbooks teach the process. Yet somehow, 99% of people have no idea this is happening. They think money comes from the government. They think banks lend out deposits from other customers. They think there's some vault somewhere with stacks of cash backing every loan. All of this is completely wrong. Here's what actually happens when you walk into a bank and ask for a loan. The bank doesn't check if they have enough money in their vault. They don't transfer funds from other depositors. They don't call the Federal Reserve and ask for cash. Instead, they open up their computer system, type in your loan amount, and create that money instantly. Brand new money that didn't exist 60 seconds before you signed the paperwork. Let me prove this to you with a simple example. You walk into a bank and ask for a $100,000 mortgage. The bank approves your loan. Where does that $100,000 come from? If you ask the average person, they'd say the bank takes deposits from other customers and lends that money to you. This is called the intermediation theory of banking. Banks are just intermediaries between savers and borrowers. It sounds logical. It's taught in schools, and it's completely false. Here's what really happens. The banker opens your file on their computer. They create a new account in your name. They type 100,000 into the account balance. That money now exists. It didn't exist before. The bank didn't take it from anywhere. They didn't move it from some other account. They created it from nothing. This is called credit creation, and it's the foundation of our entire monetary system. But wait, you might say banks need reserves. They need to have some real money backing these loans. This is partially true, but not in the way most people think. Banks do need reserves, but only a tiny fraction of what they lend out. In the United States, banks are required to hold reserves equal to about 10% of their deposits. But here's the crucial part. They can create the loan first and find the reserves later. Think about what this means. A bank can create $1 million loan with only $100,000 in reserves. They've just created $900,000 from thin air. And if they can't find the reserves immediately, they can borrow them from other banks or from the Federal Reserve. The loan gets created regardless. This is why banks make so much money. They're not just earning interest on money they already have. They're earning interest on money they created from nothing. When you pay back a $100,000 loan plus interest, you're giving the bank real money, real value, in exchange for numbers they typed into a computer. It's the most profitable business model ever invented, but the implications go far beyond bank profits. This process of money creation determines how much money exists in the economy. And since money is the medium of exchange for everything else, this process controls the distribution of resources, the level of prices, the rate of inflation, and ultimately who gets rich and who stays poor. Let's break down exactly how this system developed and why it works the way it does. For most of human history, money was commodity money. Gold, silver, shells, cattle, anything with intrinsic value that people agreed to trade. If you wanted to lend money, you had to actually have money to lend. Banks were warehouses. They stored gold and charged fees for safekeeping. When they made loans, they lent out actual gold from their vaults. This system had natural limits. You couldn't lend more gold than you had. You couldn't create gold from nothing. The money supply was tied to physical reality. But somewhere along the way, something changed. Banks realized that most depositors never came to withdraw their gold at the same time. They could lend out more gold than they actually held in reserve. This was the beginning of fractional reserve banking. At first, this was considered fraud. If a bank promised to hold your gold but secretly lent it to someone else, that was theft. But over time, the practice became accepted, then legalized, then encouraged by governments. Why? Because it allowed for economic expansion beyond the limits of physical money, and because governments could benefit from the system by borrowing newly created money for their own purposes. The transition from gold to paper money accelerated this process. Paper money was originally just a receipt for gold held in a bank vault. You could take your paper to the bank and exchange it for real gold. But gradually, the link between paper and gold was weakened, then severed completely. By 1971, when President Nixon ended the gold standard, money became pure fiat currency. Legal tender backed by nothing but government decree. This is when money creation really exploded. Without the constraint of gold reserves, banks could create money limited only by regulatory requirements and market demand for loans, and both of those limits proved to be quite flexible. Regulations were loosened repeatedly. Market demand for loans was stimulated through low interest rates and easy credit standards. The result is the system we have today, a system where the total money supply is essentially unlimited, where banks create money when they make loans and destroy money when loans are repaid, where the amount of money in circulation depends not on some fixed standard, but on the lending decisions of private banks and the monetary policy of central banks. But here's what makes this system truly extraordinary. The money that banks create isn't just temporary. It doesn't disappear when the loan is made. That newly created money enters circulation. It gets spent, deposited, lent out again, creating even more money through a process called the money multiplier effect. Here's how it works. Bank A creates a $100,000 loan for you to buy a house. You give that money to the home seller. The seller deposits the money in Bank B. Now Bank B has a $100,000 deposit. Under fractional reserve rules, they can lend out $90,000 of that deposit to someone else. Bank B creates a new $90,000 loan. That money gets spent and deposited in Bank C. Bank C can now lend out $81,000, and the cycle continues. From the original $100,000 created by Bank A, the banking system has now created $100,000 plus $90,000 plus $81,000 in new money. The total money supply has expanded far beyond the initial loan. Economists estimate that every dollar created by banks ultimately becomes about $10 in the total money supply through this multiplier effect. This is why the money supply grows exponentially over time. It's not growing because the government is printing more cash. Physical currency makes up only about 3% of the total money supply. The rest exists only as digital entries in bank computers. Numbers on screens representing money that was created through the lending process. The scale of this creation is staggering. In the United States alone, banks create approximately $4 trillion in new money every year through lending. That's more than the entire federal budget. It's more than the GDP of most countries. And it's money that didn't exist until someone signed a loan agreement. But who decides where this newly created money goes? That's where the real power lies. Banks don't create money randomly. They create it selectively, based on who they think will pay it back with interest. This means the banking system essentially decides which projects get funded, which businesses expand, which individuals can buy homes, and which sectors of the economy receive investment. Think about the implications. Every time a bank approves a loan, they're not just moving existing money around. They're creating new purchasing power and giving it to specific people for specific purposes. When they approve a $1 million loan for a real estate developer, they've just created $1 million that can bid up property prices. When they approve student loans, they create money that bids up education costs. When they approve corporate loans, they create money that flows to business expansion. This selective money creation shapes the entire economy. Industries that banks view as profitable get flooded with newly created money. Industries they view as risky get starved of funding. Geographic regions with good banking relationships get more money creation. Areas without major banks get less. The result is that economic growth becomes concentrated in sectors and regions that banks favor. But there's another layer to this system that makes it even more powerful. The interest charged on these newly created loans. Remember, banks create the principal amount of every loan from nothing, but they don't create the interest. That interest has to come from money that already exists in circulation. This creates a mathematical problem that most people never consider. Let's say the banking system creates a total of $1 million in new loans, all at 5% annual interest. At the end of the year, borrowers need to repay $1,050,000. But only $1 million was created. Where does the extra $50,000 come from? It has to come from money that was created by previous loans, or from new loans that create additional money. This means the system requires continuous expansion. New money must constantly be created, not just to fund new economic activity, but to provide the interest payments on previous money creation. If the money creation process ever stopped, there wouldn't be enough money in circulation to pay back all the loans plus interest. The system would collapse. This is why economic growth isn't just encouraged in our system, it's mathematically required. The economy must grow continuously just to generate enough money to service the debt that created most of the money supply in the first place. Any significant slowdown in money creation leads to defaults, bank failures, and economic recession. Central banks understand this dynamic perfectly. When economic growth slows, they don't just lower interest rates to encourage borrowing. They often bypass the commercial banking system entirely and create money themselves through a process called quantitative easing. The Federal Reserve creates digital dollars and uses them to buy government bonds, corporate bonds, and other securities. This injects newly created money directly into financial markets. During the 2008 financial crisis, the Federal Reserve created over $3 trillion through quantitative easing. During the COVID pandemic, they created another $4 trillion in less than 2 years. That's $7 trillion created from nothing to prevent the money creation system from collapsing. And this money doesn't disappear after the crisis ends. It remains in circulation permanently, adding to the total money supply. But quantitative easing reveals something crucial about money creation that most people miss. If central banks can create trillions of dollars instantly to buy government bonds, why do governments need to borrow money at all? Why do they need to pay interest to bondholders? Why do they need to tax citizens to fund their operations? The answer exposes the true purpose of the current monetary system. Governments could theoretically create their own money directly, without borrowing it into existence. Some countries have done exactly this. But under the current system, governments choose to borrow newly created money from banks and pay interest on it forever. This creates a permanent transfer of wealth from taxpayers to the financial system. Every dollar of government debt represents money that was created by banks and lent to the government. Citizens pay taxes to service this debt, but the money being paid back with interest flows to whoever owns the government bonds. Often, this is the same financial institutions that created the money in the first place. It's a system where banks create money from nothing, lend it to governments, and then receive real value back in the form of tax payments plus interest. The scale of this wealth transfer is enormous. The United States government pays over $800 billion per year in interest on the national debt. That's money flowing from taxpayers to bondholders for the privilege of using money that was created from nothing. Other countries follow similar patterns. Interest payments on government debt represent one of the largest wealth transfers in human history, happening continuously and largely invisible to the people funding it. But individual borrowers face the same dynamic. When you take out a mortgage, you're not borrowing money that the bank saved up from previous deposits. You're borrowing money that the bank created specifically for your loan. But you have to pay back that created money plus interest using money you earn from your labor. You're trading real work, real value, real time from your life to pay back money that was created with a few keystrokes. This is why debt levels have exploded over the past 50 years. It's not because people became more irresponsible. It's because the money creation system requires increasing levels of debt to function. More loans must be created continuously to provide the money needed to pay interest on existing loans. The total debt in the economy must grow exponentially, or the system breaks down. In 1970, total debt in the United States was approximately $1 trillion. Today, it exceeds $90 trillion. That's not growth. That's exponential expansion driven by the mathematical requirements of a debt-based monetary system. Every dollar of that debt represents money that was created by banks and must be paid back with interest. The housing market provides a perfect example of how this system works in practice. When banks create more money for mortgages, home prices rise. Higher prices require larger loans, which means more money creation. The newly created money bids up prices further, requiring even larger loans. The cycle becomes self-reinforcing. From 1970 to 2020, median home prices in the United States increased by over 2,000%. During the same period, median household income increased by about 800%. The difference was made up by newly created mortgage debt. Banks created progressively larger amounts of money to fund home purchases, driving prices beyond what incomes alone could support. This pattern repeats across every sector of the economy. Education costs have skyrocketed alongside the expansion of student loan creation. Healthcare costs have exploded as medical financing became more available. Stock prices have inflated as banks created more money for investment purposes. The common factor is money creation driving prices beyond what would be sustainable without debt. But the system has another feature that makes it even more concentrated in its effects. Not everyone has equal access to newly created money. Banks lend primarily to people who already have assets to serve as collateral. Wealthy individuals can borrow millions at low interest rates because they own real estate, stocks, and businesses that banks accept as security. Meanwhile, people without existing assets face higher interest rates, smaller loan amounts, or complete exclusion from the money creation process. They can't access newly created money to buy appreciating assets. Instead, they often pay rent to people who use newly created money to buy rental properties. They pay interest on credit cards and personal loans at rates much higher than what wealthy borrowers pay on mortgages and business loans. This creates a feedback loop where money creation increases inequality. Those with access to newly created money can buy assets that appreciate as more money is created. Those without access watch prices rise beyond their reach while their wages fail to keep pace with monetary expansion. The gap between asset owners and non-asset owners widens with every cycle of money creation. The concentration of newly created money among asset owners explains why wealth inequality has reached levels not seen since the 1920s. It's not because the wealthy are necessarily more productive or innovative. It's because they have preferential access to the money creation process. They can borrow newly created money at low rates to buy income-producing assets, while everyone else competes for jobs using wages that haven't kept pace with monetary expansion. Consider what happens when a billionaire wants to buy a company. They don't use their own money. They go to banks and borrow hundreds of millions in newly created funds. The bank creates this money instantly because the billionaire has sufficient collateral. This newly created money allows them to outbid anyone trying to buy the same company with saved money or earnings. The acquisition gets financed with money that didn't exist until the loan was approved. Meanwhile, a small business owner trying to expand faces entirely different conditions. Banks scrutinize their cash flow, demand personal guarantees, and charge higher interest rates. If approved at all, they receive a fraction of what wealthy borrowers can access. The money creation system inherently favors large-scale borrowers over small ones, established wealth over emerging entrepreneurs. This bias extends to entire sectors of the economy. Banks readily create money for real estate development because property serves as excellent collateral. They create money for stock buybacks because publicly traded companies have predictable cash flows. They create money for merger and acquisition activity because established businesses have track records. But they're reluctant to create money for truly innovative projects, social enterprises, or anything without traditional collateral. EOSA. The result is that newly created money flows disproportionately toward financial engineering rather than productive investment. Companies borrow newly created money to buy back their own stocks, inflating share prices without creating any new goods or services. Real estate developers borrow newly created money to build luxury housing that sits empty while working families can't afford homes. Private equity firms borrow newly created money to buy companies, load them with debt, and extract fees regardless of whether the businesses improve. This misallocation of newly created money has profound consequences for economic productivity. When money creation flows primarily toward asset price inflation rather than productive investment, the economy becomes increasingly financialized. More resources go toward moving money around rather than creating genuine value. The financial sector grows while manufacturing, infrastructure, and research receive less investment. The numbers tell the story. In 1950, the financial sector represented about 2.5% of U.S. GDP. Today, it represents over 8%. This expansion happened not because financial services became more valuable to society, but because the money creation process increasingly favored financial activities over productive ones. Banks create more money for financial engineering because it generates higher returns with less risk than funding actual production. But there's another aspect of money creation that reveals just how artificial our monetary system has become. The timing of money creation follows predictable patterns that have nothing to do with economic needs and everything to do with banking incentives. Banks create more money at the end of fiscal quarters to boost their lending numbers. They create less money during regulatory examinations to appear more conservative. They create massive amounts during economic panics to prevent system collapse. These timing patterns create boom and bust cycles that seem random but are actually driven by the mechanics of money creation itself. When banks increase their money creation, asset prices rise and economic activity accelerates. When they reduce money creation, prices fall and recession follows. The entire business cycle becomes a function of banking decisions about when and how much money to create. Central banks attempt to manage these cycles through interest rate policy and regulatory requirements. When they want more money creation, they lower interest rates and reduce reserve requirements. When they want less money creation, they raise rates and tighten regulations. But this gives central banks enormous power over economic outcomes. Their decisions about money creation affect every price, every investment, every job in the economy. The Federal Reserve's power to create money extends far beyond domestic policy. Since the dollar serves as the global reserve currency, Federal Reserve money creation affects every country on Earth. When the Fed creates trillions of dollars through quantitative easing, Those dollars flow into global markets, driving up asset prices worldwide. Countries that don't control their own money creation find themselves subject to American monetary policy decisions. This global dimension of money creation reveals another layer of wealth transfer. Developing countries often borrow dollars created by American banks to fund their development projects. When those dollars become more expensive due to Federal Reserve policy changes, developing countries face debt crises. They're forced to implement austerity measures, sell national assets, and restructure their economies to service debts denominated in a currency they don't control. The International Monetary Fund and World Bank facilitate this process by providing newly created dollars to countries facing debt crises. But these institutions require structural adjustments in exchange for their newly created money. Countries must privatize public services, eliminate trade protections, and open their markets to foreign investment. The newly created money comes with conditions that reshape entire national economies according to the preferences of the money creators. Even within developed countries, the geographic distribution of newly created money creates regional inequality. Banks concentrate their money creation in major financial centers like New York, London, and Tokyo. These cities receive disproportionate amounts of newly created money for real estate, business expansion, and financial services. Rural areas and smaller cities receive much less newly created money, causing them to fall behind economically. The COVID pandemic revealed just how arbitrary these money creation decisions can be. In response to economic lockdowns, central banks created more money in 2 years than they had created in the previous decade. The Federal Reserve's balance sheet expanded from $4 trillion to $9 trillion. The European Central Bank, Bank of Japan, and other major central banks followed similar patterns. This massive money creation prevented economic collapse, but it also demonstrated that money scarcity is a policy choice rather than a natural constraint. If central banks can create trillions instantly during emergencies, why do they restrict money creation during normal times? Why do governments claim they can't afford healthcare, education, or infrastructure, when the money to fund these programs could be created just as easily as pandemic relief money? The answer reveals the true function of money scarcity in our economic system. Artificial scarcity maintains the value of existing money holdings and preserves the wealth of those who already own financial assets. If money were created freely for public purposes, it would dilute the value of existing money and reduce the relative wealth of current money holders. The restriction of money creation serves to protect established wealth rather than to maintain economic stability. This protection of existing wealth through money creation restrictions explains why inflation is treated as an existential threat, while unemployment and poverty are considered acceptable trade-offs. When newly created money flows to financial markets, as it did during quantitative easing, asset prices rise dramatically without triggering inflation concerns. But when newly created money might flow to ordinary people through stimulus payments or job programs, inflation suddenly becomes a primary policy concern. Now you understand the truth about money. Banks don't lend money they have. They create money from nothing when they make loans. This process determines who gets rich and who stays poor, which sectors grow and which ones starve, how wealth concentrates among those with access to newly created money while everyone else falls behind. The system isn't broken, it's working exactly as designed. The question is, now that you know how the machine operates, what are you going to do about it?